Welcome to the Essential Guide for Business Owners in 2026. We're protecting your most valuable asset, which is your human talent, has never been more critical. Today, we are exploring the complex and vital world of key person insurance, a financial safety net that ensures your company can survive the unexpected loss of a core leader. In the modern business landscape, where specialized knowledge and leadership are the primary drivers of growth, the sudden absence of a key individual can be devastating. Whether you are running a tech startup or a traditional manufacturing firm or a high-growth service agency, understanding how to protect your leadership capital is the difference between long-term resilience and a total collapse. At its core, key person insurance is a life or disability insurance policy taken out by a business on its most important employees. In this arrangement, the company is the policy owner and the premium payer and the beneficiary. If the key person passes away or becomes incapacitated, the insurance company pays out a death benefit or a disability settlement directly to the business. This capital is intended to provide financial cushion while the company searches for a replacement or pays off outstanding debts or manages the inevitable dip in revenue that follows a major leadership change. Before we dive into the technical details of taxes and policy types, we must first identify who actually qualifies as a key person. It is not always the person with the highest title. A key person might be a founder with a unique vision, or a lead software architect with proprietary knowledge, or a top-performing salesperson who manages 8% of the company's client relationships. If the loss of an individual would cause immediate and significant financial harm to the organization, they are a candidate for this coverage. When choosing a policy for 2026, business owners generally have three primary paths to consider. The first and most common is term life insurance. This is the most affordable option because it provides coverage for a specific period of time, such as 10 or 20 years. Term insurance is ideal for businesses that want the highest amount of protection for the lowest possible cost during a critical growth phase. It is a straightforward contract where if the insured person passes away during the term, the business receives the payout. The second option is whole life or permanent insurance. These policies are significantly more expensive, but they remain in place for the life of the individual and build cash value over time. In 2026, many savvy business owners use the cash value in a permanent policy as an asset on the company's balance sheet or even as a source of emergency liquidity. The third and often overlooked type is key person disability insurance. Statistically, a key leader is more likely to suffer a long-term disability than they are to pass away before retirement. This policy provides the business with a monthly benefit to hire a temporary consultant or to cover the overhead costs while the leader is recovering from an illness or an injury. Now let us tackle the most important question for any business owner, which is the tax deductibility of these premiums. In the eyes of the Internal Revenue Service and most global tax authorities, the rules are very specific. Generally, premiums paid for key person insurance are not tax deductible. The reason for this is that the business is the beneficiary of the policy. Because the company stands to receive the payout, it is not allowed to write off the cost of the premiums as a business expense. While this might initially feel like a disadvantage, there is a massive silver lining for your 2026 financial planning. Because the premiums are paid with after-tax dollars, the eventual death benefit received by the business is typically 100% tax-free. This means that if you have a $5 million policy on your chief technology officer and they pass away, your business receives the full $5 million without having to lose a large percentage to the government. This tax-free injection of Capital is exactly what a company needs to stabilize its operations and maintain investor confidence during a crisis. However, there are specific nuances to this rule that business owners must be aware of to avoid legal trouble. To ensure the death benefit remains tax-free, the business must comply with the employer-owned life insurance rules. This involves providing a formal written notice to the employee about the intent to insure their life and obtaining their written consent before the policy is issued. You must also prove that the employee was either a highly compensated individual or an owner of the business at the time the contract was issued. Failing to follow these administrative steps can result in the entire death benefit being treated as taxable income, which would be a catastrophic mistake for your financial strategy. Furthermore, if you are using the policy to fund a buy-sell agreement, the way the ownership is structured can change the tax implications. In a cross-purchase agreement, where partners buy policies on each other, the tax rules differ from an entity purchase agreement, where the company buys the policy. Consulting with a tax professional in 2026 is essential to ensure your specific structure is optimized for your goals. Beyond just the cash payout, key person insurance plays a vital role in maintaining the creditworthiness of a business. When a company loses a founder or a major rainmaker, lenders often become nervous about the business's ability to repay its loans. In many cases, banks will actually require key person insurance as a condition for approving a business loan or a line of credit. Having a policy in place acts as a guarantee to your creditors that the business will have the liquidity to satisfy its obligations even if the primary driver of the business is no longer there. This is particularly important for high-net-worth individuals who have personally guaranteed business debts. Without key person insurance, the death of a founder could lead to a sudden call on loans that could force the company into an unwanted liquidation. In the 2026 economy, we are also seeing an increase in the use of key person insurance to protect against the loss of specialized talent in the tech and animation industries. For a content creator or an animation studio, the loss of a lead animator or a scriptwriter who defines the brand's voice can stop production for months. This is where the insurance payout can cover the high costs of headhunters and signing bonuses needed to attract a world-class replacement on short notice. It provides the breathing room to pivot the brand or train existing staff without the pressure of an immediate financial collapse. When determining how much coverage to buy, most experts recommend using a multiple of the key person's salary or a percentage of the total revenue they generate. A common rule of thumb is to seek coverage that is 5 to 10 times the individual's annual compensation. You should also factor in the cost of hiring a